Okay, let's go. All right, great. So I'll make sure that I'm sharing my screen. Great. Welcome to today's webinar. I appreciate your time and welcome to those of you watching the recording. My name is Walter Peters and you're here at the Naked Trading webinar. Today we're going to talk a little bit about psychology, 5 simple mind hacks for traders. And we're not only going to talk about the issues, the problems, the situations that we run into as traders, but we're also going to talk about the solutions. So, and then at the end we can look at the chart. So bring, if you have a chart that you'd like to have a look at, and I'm happy to look at those too. So many of you know I'm a full-time trader. I wrote the book called Naked Forex, but you may not know that I also am what's known as an experimental psychologist, which simply means that I studied psychology from a research point of view and didn't really learn anything about analyzing you or making sure that you can work through your issues that we all sort of collected when we were younger. So don't know anything about therapy, just know about thinking. I studied thinking about your thinking. And it turns out that some of these things that we think about as traders have a psychological basis. And that's what we're going to talk about today. So experimental PhD in psychology, that's sort of my background. So I look at things often from a psychological point of view. And I often kind of relate trading things to the research in psychology. All right, so let's talk about the first one, number 1, which is, and if you guys have the answers here, I would love to hear you chime in, because some of these concepts we're going to talk about might sound a little bit weird, but if you know what it is, go ahead and chime in, because I'd love to get your take on this stuff, because sometimes I feel like I don't really know the level that people are at in terms of jargon and stuff like that. I don't want to go too high and too tricky, but the great thing about psychology is we're all sort of amateur psychologists, and if you listen to what people talk about, they're almost always talking about social psychology and sometimes cognitive psychology, where they'll say, well, the reason why so and so does this is because his mother was like this or whatever. You hear people talking about that all the time. If you ever hear, especially women gossiping, men do it too, but not to the same extent. Like, they're often talking about psychology. So we all kind of have our own little pet theories. So the first one I want to talk about here today is apophenia. Does anybody know what apophenia is? And why on earth would I talk about it? How does it relate to our trading? What is apophenia? I'm going to write it up here so you can see. Apophenia. So what's apophenia? What is that? What how does that affect our trading? Anybody know? Apophenia. That's a weird one. It's a weird word. Doesn't even sound like it sounds like a word that some academic made up. Apophenia. What is apophenia? Anyone know? It's not fair if you Google it. If you type it into Google, it doesn't count. This is a big one, by the way, too. A lot of people would argue that I fall victim to. We all fall victim to all of these, but some of them are more important for some of us than others. So some of these are going to be really hit home, and other ones are going to be, I don't know about that. It turns out, I'm just having a drink of water here. It turns out apophenia is the tendency we have as humans to see meaningful patterns inside random data. Now, isn't that weird? We see meaningful patterns inside random data. What is that? I'll give you an example. Well, actually, one of my favorite studies in psychology was where they give people a random number table. And if you've ever taken a statistics course, you know that a random number table can be quite important because you can use that. If you ever been to the airport when they pull you over and they say, well, you've been randomly selected for screening for bombs or whatever, and they swipe your hands and your luggage and stuff like that to see if there's any explosives stuff on your body or your belt or whatever. They were using a random number table. They were using a random number algorithm to select the people that go through there to test them out. And you use the same thing when you assign people in experiments to either, one group or the other, or if you have several groups, like 4 or 5 groups, you can randomly assign people using a random number table. Well, these researchers gave random number tables to people, and they said, what's going on here? What's the pattern in the numbers? And surprise, surprise, everyone came up with a reason why the numbers were related, and they weren't, because by definition they were random. It's one of my favorite studies, and it relates to Apophenia because Apophenia. I'll give you a trading example here. Let's say that you see a pattern, okay, and that pattern is where if there are 3 candles that go bullish or bearish, let's go to the 5-minute charts here. And let's say that you see this pattern where, wherever there are 3 candles that are bullish or bearish, it means that the market's going to go higher. So you see one here. You see another bullish candle here. I mean, technically, that wasn't really very, very bullish because it closed below the midway. It did close higher than it opened. Here. So whenever you see 3 bullish candles, you go, I'm going to go long. Okay. Here's another example here. We have another 3 candles, 1, 2, and 3, and they're all, quote, bullish, although I would argue that they're not, but that they did close higher than they started. So you say, oh, I'm going to go long. Notice that market retraced too. It came back down lower. So that's if you know your candlestick stuff, that's what's known as the 3 soldiers, and it doesn't work. I've tested it, and it's a complete loser. In fact, I don't even know where. Maybe it worked at some stage. Maybe it works in stocks or something. But as far as I'm concerned, whoever came up with that, it's crazy because it doesn't work. I've never been able to get it work. Maybe you can. Maybe you can test it, make it work. But what I've noticed is that if you ever see 3 bullish candles in a row or 3 bearish candles in a row, I would say get ready for a move in the other direction. In fact, there are some mean reversion traders that use that kind of thing. They just go, well, after 2 bullish days they sell, or 2 bearish days they sell, or stuff like that. So, so here's another one. Here's a bullish candle here, number 1, bullish candle 2, bullish candle 3, and then it falls. But let's say that you see these bullish candles, and whenever you see these 3 bullish candles, you notice the market tends to go up, and whenever you see 3 bearish candles, it tends to go down. So you decide that's going to be your strategy. So it's an obvious thing. You're just going to go test it. I mean, you're going to go trade it without even testing because it's obvious. If it's strong, the market's going to make 3 strong bullish candles, and you go long. And if it's bearish, you're going to go short. Well, the reason why this is Apophenia is because you see this pattern in the charts when you scroll back, but the fact is it's a losing strategy. At least my testing has shown that it's a losing strategy, and perhaps yours has as well. And so the solution for Apophenia is to backtest. That's the solution. To actually go back, use something such as Forex Tester. I like using Forex Tester. There are other solutions. I think one of my students is using Trader's Gym. I don't know if anyone's used that. So there are other solutions out there. It's not just Forex Tester, but I'm used to Forex Tester at this stage, so I like using that one. So that's the one I use. It's Forex Tester. So does everyone understand Apophenia? So that's one issue that we have as traders, is we see these patterns and we think that it's obvious that you should be taking a trade here or whatever. And it turns out that that's not always the case. Sometimes we see things that aren't really there. We see profitable patterns in the charts when we scroll back, when we kind of skim over the losing trades or the losing setups. So the solution here is obviously to simply use a backtesting simulator so that you can go back and at least historically work out whether or not it would have worked. Okay, so that is Apophenia, solution backtesting software. And if you're a manual trader, then you should probably use a manual backtesting, not MetaTrader, Strategy Tester, or whatever, or any other TradeStation or whatever. All right, let's move on to, so that's Apophenia sorted. Let's move on to the next one, which is optimism bias. Optimism bias. What is optimism bias? What is that? What's optimism bias? Anybody know what that is? Any ideas? Optimism bias. What is that? What is optimism bias? Optimism bias is exactly as it sounds. It's also known as comparative optimism or unrealistic optimism. It's this cognitive bias that we have where we believe that we're less at risk of experiencing a negative event compared to others. So, for example, you might say, I'm not going to get in a car accident. The reason why, it actually doesn't have to do with optimization. Optimism bias is a more general one, actually, where we say, I'm not going to get in a car accident. No chance. Even though, do you know what your chances are of dying in a car accident? Does anybody know? Over your lifetime. Not over the next year, over your lifetime. What are the chances that you're going to die in a car accident? That any of us might die in a car accident? Chances are actually 1 in 84. So that's better than a 1% chance. It's actually a pretty high chance, because when you think about things like shark attacks, people are totally scared of sharks, especially here in Australia where I live. Your chance of dying from a shark attack are 1 in 3.748067 million. 1 in 3,748,067. In fact, all these things like fireworks, lightning, drowning, they're all less likely to happen than getting killed in a car accident. But people are worried about lightning, and they're worried about sharks, and they're worried about drowning and all these things. But really, it's a car. Car is the most dangerous thing. So optimism bias is we think it can't happen to us. It's not going to happen to us. Well, here's a trading example. You might say, look, I know that this strategy is not, like, if I just took it mechanically, it's not going to make money if I took every single signal, but I know the good ones. I know the signals that are good, so I'll just take the positive signals, the good ones, and I'll forget about the other ones, right? That's optimism bias. So what is the solution for optimism bias? How do we combat optimism bias? Does anybody know? What can you possibly do to combat optimism bias? What might you do? Any ideas? What might you do to combat optimism bias? Remember, we're saying this can't happen to us. We believe that our chances of experiencing something like this are less compared to others. The answer is, I'll write it up here for you. The solution for optimism bias is to write in a trading journal. That's the solution. Yeah, you can look at things like, statistics. That's another thing. Like, if you have good stats, and if you've gone through Forex Tester and you've done your homework, and by the way, when you're doing testing in Forex Tester, it's a really good idea to only do it for like 30 or 40 minutes, because you tend to get sloppy. If you sit there and pound out, 3 hours of back testing and Forex Tester, you'll notice that the first trades you take are going to be, you're going to be more conscientious than the last ones. And so that's another thing that can kind of mess you up. I prefer to do it in short spurts, take breaks, that kind of thing. And, you know, most of the things that I've tested 3 new strategies in Forex Tester in the last 3 weeks, and all of them have been dogs. They're not worth really much. So they don't move on to the next phase. So for me, it has to go through Forex Tester. I have to triple my account in Forex Tester. Then I go demo. I like to go to a small live account. And if it can get through all of that, then I'll move it to a larger account. That's strategy. But I won't do it if it doesn't make it through Forex Tester. So a lot of ideas that I get. Yeah, Forex Tester is a software. You can get a course. I've got a free course for you if you want to. If you want to see how it works. It's a simulator. So nanocast.com/Forex Tester. That's a free course if you want to do it. You know, it's up to you. I also have a discount link if you guys want one. If you guys want if you don't have it, it's brilliant. It really is. I don't know any traders that do well that don't spend a lot of time testing in Forex Tester. Just put it that way. So I mean, it's up to you. But I mean, people say, well, I'll get it when I can afford it. Well, you can afford to open up an account and lose a bunch of money. but you can't afford to pay for Forex Tester, you know? You don't have to get subscription. It can be a one-time fee, and I've got a discount here. Doesn't really matter. I'm not here to sell you on Forex Tester. I'm here to say use something like it. If you don't use Forex Tester, use something like it. Use a simulator to get your confidence up. Use a simulator to get your statistics. That's really important. Now, you can also write in a trading journal, and you'll put the why are you taking the trade, how did the trade work out, your rating for the trade, you know, that you, like, let's say you have a 5-star rating, okay, for your trades. Let's say that you, whenever you take a trade, you rate it between 1 and 5 stars, okay? And you go back, and after 50 trades, you check and you see, did I really do better? Do I have a higher win rate with my 5-star trades than I do with my 3-star trades? If that's the case, then maybe I don't take my 3-star trades. But you're also just as likely to find out that maybe your 3- and 2-star trades were better, had better results, made more money than your 4- and 5-star trades. So that's another thing to keep in mind. You know, when they taught the turtles, everyone knows about the turtle experiment. It's talked about in Market Wizards. Some of those are interviewed, I think, in the new Market Wizards, some of the turtles. They actually taught them, Richard Dennis and William Eckhart taught the turtles to go against their gut. So if they could only take one trade because they didn't have enough money, you know, because they can only take so many trades at any given time. If they have 2 trades, they should go with a trade that they thought was the least likely one to work out. And the reason why is because your instincts are wrong, especially when you first start trading, like, you know, they were new to trading. It's a really good tip that your instincts are wrong. Go with the one that you don't think is going to be good. So yeah, so that's basically one way to get over this is to write in a trading journal all of your thoughts, take a screenshot before and after. You can also use a video, like a video journal, but actually the act of actually writing, using a pen or pencil and writing, that activates a different area of your brain, and you're going to learn it. If you just take a screenshot and paste it into a Word doc or whatever, or a Google Doc, or you even type in a keyboard, that's different. It's a different area of the brain that's activated. So it's highly, highly suggested that instead of doing that, you actually write it down, physically write it down. Yeah, we'll look at the Aussie and the Kiwi FX ambassador. I just hit my target on the Kiwi finally after waiting for so long. We'll definitely have a look at that one. So that's optimism bias. Let's keep moving on. If there are any questions about that, we'll move on to the next 3. Illusory correlation. What is an illusory? Does anybody know? Something that they'll talk about if you are taking research methods or experimental design. Statistics, it comes up. I used to teach research methods at university. So that's what they do when you get your PhD. They slave labor you so that you can teach courses much cheaper than a professor. They say that they want you to get experience teaching, but really it's because, you know, they can pay you 1/15 of what the professors get paid. And the professors don't get paid that much either. Okay, so illusory correlation is the phenomenon of you perceive a relationship between some two things, usually people or events, or behaviors, even when there's no relationship. So you see something going on there, seems to be related, but it's not. I'll give you an example. One example would be that you might go through the statistics and find out that most pedestrians, when they're walking across the road or near the road, they're killed by cars most of the time in a crosswalk, in a pedestrian crosswalk, where they're supposed to cross the road. So you think, well, there's something really dangerous about crosswalks. So when I'm crossing the road, I will never walk into a crosswalk because I know that that's where most pedestrians get mowed over by cars. So, of course, what's the problem with that? What's the problem with saying I'm never going to cross the street in a crosswalk because most pedestrians are hit by cars in a crosswalk? Why should I, like, what's the deal? What's going on here? Obviously, the reason why most fatal pedestrian accidents are in a crosswalk is because most of the pedestrians, when they cross the street, it's almost always where? It's almost always right there on, yeah, exactly. Most pedestrians, when they cross the street, they're in the crosswalk. That's why most pedestrians who are killed in the crosswalk, because that's where most of them are. So it's actually not the relationship. It's not that crosswalks are dangerous, it's that that's where all the pedestrians are. So a trading example would be, you have a trade and the trade was stopped out because you took that trade right before the news came out. So let's say there was a news event called the excess corn on the cob account news release in New York. And so all this excess corn on the cob was being reported, and of course the market spiked, and you were in on the euro yen, and you got stopped out on your euro yen trade. So you decide to avoid taking these daily chart trades. Even though you're trading the daily chart and you have a wide stop, you were stopped out on the report. So you're not going to take your daily chart trades right before this report anymore because it's too dangerous, right? That would be an illusory correlation. Especially if you've tested in Forex Tester and you didn't avoid news releases when you were testing in Forex Tester. Sometimes the news will fuel your trade and make it go toward your target or get you into profit, and sometimes it'll go against you and stop you out. That's just trading. That's the way it works, right? Okay, so all right, so let's keep going. What's the solution then for illusory correlation? What can we do? Any ideas? We're seeing these relationships that don't exist. How do we get around that? How do we avoid, or what's the antidote for illusory correlation? Does anybody know? Anybody? Bueller? Anyone? I'm just going to drink my water here while I wait for your answers to come through. It's a tough one. So yeah, one of the things that I would say is a different perspective. So one of the issues with traders is we tend to focus on the micro too often instead of the macro. And that's a hint. That's a big hint here. We should be comparing chunks or sequences or series of trades instead of basing our system or changing a trading system based on a single trade. So in the trader example, because your daily chart trade was spiked out because you took it right before the excess corn on the cob report came out in New York, you decided you're not going to take daily chart trades before that report anymore. Well, That's one result. Who knows? Maybe, taking that trade right before the excess corn on the cob report would have done really well for you, 9 out of the last 10 months, but just this month you happen to get spiked and stopped out on your signal. That's the kind of thing that we're trying to avoid here. And so the solution is we will simply do this. We will simply compare and analyze chunks of trades. We're not going to look at one trade. We're not going to look at two trades. We're not even going to look at three. We're going to look at chunks of 30 or 50 trades. That's the key here. And this is exactly the way that the casino does it. When the casino tallies up at the end of the day, say, how much money did we make in our, let's, for example, say in the blackjack tables, how much money did we make in the blackjack tables? And they say, well, we lost 700,000 today on the blackjack tables. Really? We lost 700,000? Yeah. Well, what was going on today? Oh, well, there was an engineers conference at the hotel. Let's say this is a casino in Vegas and it has a big hotel, right? So yeah, we had an engineers conference, and a lot of those engineers, they're smart guys. Maybe they're counting cards or something. So, oh, okay. So the pit boss decides, or the manager decides, we're gonna, next year when the engineers conference comes through, if they're in our hotel, we're just going to shut down a lot of the blackjack tables. We won't have a lot of dealers out there because we lose money, when the engineers are in town. They're too good at blackjack or whatever. That would be an illusory correlation. That'd be crazy. Casinos don't do that, right? They don't do that. They're looking for anomalies, okay? Just like, when at the assembly line at Ford, they're looking for anomalies too in all the car parts before they put the car together, right? But they are interested in chunks of data, not just one. They're not going to change what they do because they lost money at the blackjack tables one day. They're going to look at this week, this month, this quarter. That's what they're looking at. They're looking at the longer term. And as a trader, you should as well. You should be looking at how much money am I making this week, this month, this quarter, this year? Not, did I lose money today? Oh, I did? Okay, I got to change it up. No, that's the big, I'm convinced that the two biggest mistakes that traders make, and I talk to a lot of traders, one is not understanding risk of ruin, and two is not looking at the long game, which is think like a casino. Casino doesn't care that the casino lost today. Casino knows that the odds are in its favor and the casino will make money in the future. Same thing with if you have an expectancy that's a positive expectancy and you're not risking too much, in other words, you haven't pushed yourself too far beyond optimal F, which is another problem, but that's related to risk of ruin, then you know that you're going to make money. So all you have to do is just, time is on your side. You just got to wait it out. Wait out the drawdown. That's basically the deal. And I know it sounds easier than it is to do. We all know it's difficult to do in practice. But the important thing here is if you're tempted by illusory correlation, look at chunks of trades. Instead of trying to change your system up just because of what happened over a trade or two or three, look at big, long chunks of data, just like the casinos do. It's very important, guys. Okay, let's move on to the next one. The next bias is contrast bias. How does contrast bias affect us as traders? What is contrast bias? Contrast bias, we're going to switch it up here. We're going to go with a different color with contrast bias. How about green? Teal, okay. Contrast bias is the tendency to upgrade or downgrade mentally in our head. We upgrade or downgrade something when comparing it to something else. So there's some object, some system, some person. We upgrade or downgrade it when we compare it to something else. So here's a trading example. Let's say that I have a buddy, and my buddy's name is Trader Eddie. I'm going to call him Trader Eddie. Actually, one of my students, Eddie, he's awesome. He does more back testing than just about anybody. A lot. and he's really built up his confidence. Trader Eddie, let's say, he's making more money than I am right now. He's had a really good month, and I've been losing left, right, and center. So I'm going to dump, trash, throw in the bin my system, and go ahead and adopt Trader Eddie's. He's got a better system. His equity curve is much nicer. So I'm going to go with Trader Eddie's system and forget mine. That's contrast bias. Okay, by comparing what Eddie's doing to what I'm doing and deciding that I need to throw mine away. Well, not really a good idea, right? Not so much. And the solution here is you sort of need to see your system in context, okay? Now, there's a theory in psychology where if you've ever had that experience where like you're in one group of friends or one circle of people that you are associated with and you act very different when you're with a different group. So let's say your friends that you went to university with, you're hanging out with them, and then all of a sudden you go home and see your grandfather, okay? You're probably going to act a little bit different when you're with your grandfather than you would when you're with your circle of friends from uni, right? And if your circle of friends from university they like to drink beer and your grandfather is a recovering alcoholic or whatever, he just wants to talk about the news or the weather, and your friends at uni, they just want to talk about, their jobs or their boss that they hate or their wife that won't let them play anymore. These are the sorts of things that happen. Well, it's the same, different spheres of influence, different environments, things are completely different. That's exactly with system. Doing several trading systems, do you know which markets your trading system works well in versus another? So for example, if you have a system that takes advantage of strong moves in the market and you trade that system in a range-bound market, how would you do? So for example, let's go to the Euro Swiss. Let's say you have some sort of trend trading system and you're trading on the Euro Swiss. Well, guess what? Euro Swiss has been what? Euro Swiss has been largely inside this big, huge box. And I know it looks kind of like a big box, but about 48 pips wide. Let's call it 50. So Euro Pound's been in a 50 pip box for almost a month. And if you're trading a trend trading system with that, you're going to get chopped around. So that's what I mean by context. One antidote for contrast bias is to make sure that you know when your system does well and when it will hit drawdown. Be aware of this, even if you don't filter it out. Now, there's a slippery slope when it comes to filters. So if you're trading a trend trading system, you might only trade it once the market's made a new high or a new low, like a 50-day high or a 50-day low or a 20 candle high or 20 candle low or whatever. Then you'll flip it on. Something like that. Or if you're trading a system where you're using some sort of oscillator, obviously, it's going to completely fall apart in a trending market. If you're looking at overbought or oversold levels, when you're in a trending market, you're going to get blasted. Let me give you an example. Canadian dollar is a great one. Okay, so we're going to insert some sort of indicator here. Okay, and I'm going to put on really like this. Okay, so all right, so let's talk about this. So the Canadian dollar, the loonie, was oversold here. Okay, so we sold here. That's great. This is a 4-hour chart. So maybe you made some money there. And it was oversold and then turned back over here. Okay, so that's great. Maybe you made some money there. But then what happens when it's oversold here? Actually, would have been this candle because it crossed over the 80% level. Okay, you're blasted. You're done. And it looks like it's once again overbought, not oversold, overbought, right? It hasn't actually turned below 80, but it probably will, probably in the next 3 or 4 candles, probably will. And if it's still in this uptrend, it's going to blast people again. So the point is, these oscillators work really, really well, even though they're lagging. Price action works better, I can assure you. But even though they're lagging, this sort of thing works really, really well when you're looking at range-bound markets. Here's one there where it was oversold, and you can buy here. So it's pretty good in a range-bound market, but as soon as you start trending, it's all over. It's all over Red Rover. So that's another thing to keep in mind here is, do you know when your system will do well and when it will experience a drawdown? Be aware of this, and you might even want to filter it out. Like I said, if you're doing oscillator trading, you might want to only do it when you can draw a box around the price action and go, look, as long as the market's in this big box here, I'll do my oscillator system. If it gets out of this box, I'm not going to do it anymore because I know it's going to fail. Same thing with trend following. I'm only going to do my trend trading system when the market makes a 35 candle high or a 21 candle high or a 21 candle low. So it's the highest candle we've seen in the last 21 candles or the lowest candle we've seen in the last 21 candles, something like that, right? Cool. All right. So let's keep moving. We've got one more, guys, and then we'll move to the charts. I'm happy to look at the charts for you. So I know there's some questions coming through on pairs that you want to see. The last one is the recency bias. The recency bias. What is the recency bias? Recency bias is the phenomenon that we most easily remember something that's happened recently compared to those things that happened a long time ago in the past, right? So, yeah, it's a historical perspective. So let's say in trading that the last trade I took went 200 pips. Actually, let me show you the Aussie CAD. So the Aussie CAD gave us a signal yesterday, and the CAD yen. Aussie CAD. Okay, so all right, so here's a signal right here on the 1 hour, right? Okay. So, and I talked about this. If you're a member of the private forum, I've been talking about. I talked about this one yesterday. I think I talked about it when it was making this candle, and I said we're probably going to get a signal today, and then boom, it gave us one right there. Now, there's about 23, 24, maybe 25 pips of risk on this one, and the trade's currently up 5 pips. Okay, so it's better than 3 to 1. But here's the thing: what if I had a target that was just at 3 to 1? Okay, so I got popped out right here at 75 pips because that's 3 times 25 is 75, right? So I get popped out on this candle, and yet if I had held on to it, it's worth another 12 pips at least, depending on how much higher it goes. So what do? Well, recency bias would be that I go, well, let's say that this trade ends up going all the way up to here, to this support and resistance level. So in that case, you'd be looking at a trade that's worth 150 pips, okay, with 25 pips of risk. It's pretty good because it's 6 to 1. 6R, or for every dollar at risk, I make $6. Well, here's the thing. I might decide that instead of having that 75 pip target, because it kept going, I need to do something different. I need to have a trailing exit to take more out of the move. After all, it was a massive move, and I only took a little bite out of it. Well, that's cool if I want to trade that way. But again, trading that way just because the last trade did this or the last trade did that, that'll drive you mad and insane. If you've ever done that, and I have, I can attest to it. So the solution for that, recency bias, is to simply backtest your system, use something like Forex Tester, and compare your live trades to your backtest statistics 50 trades at a time. So just like on the assembly line, they're comparing the new Ford, car doors to make sure that they're still up to snuff. If you have, let's say that if you take a 50 trade sample and your average winner is, let's say your average winner is 95 pips, okay? So this is your trades. These are your live trades. Your average winner is 95 pips. But you look back at your backtesting statistics, which includes 621 trades in Forex Tester. Your average winner is 135 pips. Okay. So something's wrong here, right? I know that my my average winner should be about 135 pips, and it's not. It's 95. Now, you don't really know if you're completely off base unless you understand standard deviation. And maybe we'll do this in another future webinar, guys, because I think it's an important concept. But for right now, I just want to say this. It could be okay, right? We don't know if 95 is within a level of confidence. In other words, are we 95% certain or 99% certain? You can set it either way. Most of the time, people choose 95% certainty or 99% certainty. But you say, am I 99% certain that the average winner of my 50 live trades is completely different to my average winner of my back-tested 621 trades? Do you understand? So what I'm trying to do here is by using standard deviation, by using a standard deviation or a measure of variance, you can place that onto these data here, okay, your 621 back-tested trades, so you have a confidence interval. So it turns out, for example, it might turn out that it's 135 pips plus or minus, plus or minus 50. If it's plus or minus 50, then what would that be? That would be 80, 85, I think, would do it, right? Yeah. If it's plus or minus 50, then it could be that it's somewhere between 85 pips to 185 pips. If that was the measure of variance that we came up with. In other words, that could be the case. That it could be the case. You basically have to understand confidence intervals to do this. However, if our measure of variance and we had a 99% confidence interval, if it was something like 17 pips plus or minus 17 pips, then we know, okay, something's wrong. 95 is way, way, way too far outside of the confidence interval, which is basically 115, 118, if I've got my math right, between 118 and 152. It's got to be between 118 and 152 pips on average. So this is wrong. This is off. So in other words, the way that I'm trading live is completely different to the way that I back tested it, or vice versa, however you want to look at it. The point is they don't match up. So that's really important, is to check your live trades against your back-tested statistics, but do it in samples. You can't just do it in 10 trades. You got to do it in big chunks, and then you can compare it and you say, well, something's going on here. So that's a really important concept. Maybe we will do a webinar in the future on confidence intervals, so you know how to do this. So you can go, okay, this is what I found in my back test. This is what I'm finding right now live. Something's wrong or something's not wrong. Maybe that's probably going to make for a good webinar. All right, let's take a look at some of your charts, guys. We still have some time. I want to look at the Aussie and the Kiwi. So my Kiwi trade hit the 71 20 target when as low as in fact 70.99. Finally, this was a pseudo kangaroo tail here on the daily. It broke lower. I moved my stop loss to break even anyway, or plus 5 pips. It was down there at 73.68, and did not get stopped out here, luckily. I missed it by about 20 pips. Didn't get stopped out there either. So I've hit target 1, and now I'm actually waiting for 70.40. So it still is about 90 pips away from 70.40, but that's my second target on this one. And I do think that it has some room to move there. I do think so. It's obviously caught up in some support here, but I do think that it could, I mean, it could also come up here and double top or whatever, but I like the way that it looks. I like the way that the kiwi looks. If you look at this, you could say that this is a box right here and that we've kangaroo tailed on the box. This next candle is critical. If this next candle doesn't breach the high of the previous 4-hour candle, then maybe we're going to go lower. But if it does breach the high, maybe we're going to go higher. It's at a really critical spot. My Aussie, I've had this Aussie trade on for a long time. It hasn't really gone anywhere. It's come really close to stopping out. As you can see, I think that the Aussie has the potential to at least stab up here to 77.70. I know we've had historically the last couple of weeks, I had a lot of people shorting the Aussie, and it's still hanging out up here. I think that's rather bullish, and I think the weekly chart is very bullish. So I think the fact that the market's made these really strong moves, and the fact that it's just kind of sitting here on the upper edge of this big bullish weekly candle, that's a very bullish sign. Buy. That's buy me. The issue, of course, is that we're right up against this resistance level, and that's why we're seeing a bit of an issue, I think. So it's tough. I'm still in the trade. I'm not going to pull the plug. I'm either going to get stopped out or not. I still like this really nice weekly setup. I've got kind of a, like a 4-hour entry on it, so my stop's relatively tight, and so far has survived. But I'm surprised it hasn't broken, to be honest with you. I think the best trades are probably going to be on pairs like the CAD yen. So perhaps a sell off the CAD yen up here at this level at 85.50, 85.40. Also, the Aussie CAD is another one. I took that one yesterday. I mentioned there's a 1-hour chart trade right here, but there was also a daily chart trade. And that daily chart trade was just a bounce off of support. I'll show you. It was right here. So that's got to stop at 1.0028. I bought at 101.45. You can see it's at 102.15 right now. And I've got targets. I know that this is a level. I know that's going to have some problem getting through it, but it was just too close to take profit there. So I'm going for 102.80 and 103.20. So that's the other one. I also think that gold has the potential for a really nice bounce where it's at. I think that it hasn't done it yet, but if it gives us a really nice bullish candle here, we've seen some nice resistance at this level. Whoops. Right here. And right here. Right there. And right there. So we could get some bounce here. That would be a nice spot to see a bullish bounce. So that's the other one I think is interesting. I think the Euro Swiss is going to break lower, and I think it's going to do something crazy. Like, I think it's just going to go whoosh really, really fast and really, really hard. But it's got to get out of this box first. I had an order over here at 106.22 for a while. It never really touched it. And I thought it was going to squeeze. This trend line was going to pop it lower, and it didn't. It popped up. And now it's kind of stuck in the box. But if it can get out of that box, I would be really happy to short the Euro Swiss as well. So those are the ones that I'm looking at, guys. Thanks for your questions. Yeah, Aussie and Kiwi. So hopefully I covered those. Obviously, you can see the Aussie Kiwi is looking pretty bullish too. Show you. I'll delete all this stuff. The Aussie Kiwi is right up against resistance. I love it when the charts do this. This is what, in fact, it's exactly what the Canadian dollar did. Canadian dollar did this yesterday, and again, I did, in my daily, I do 2 videos a day. I talked about this. Where is the Canadian dollar? Yeah, it went up there, and And this was bullish, right? What's this silly? Oh yeah, we were looking at the stochastic. Silly stochastic. So see how it went up here and it was sitting there, and then boom, that was a bullish breakout. What a beauty. So yeah, it's a similar sort of chart. Similar sort of chart. Thanks so much for your time, guys. I hope you have a wonderful trading week. I will see you at the next Naked Trading webinar. Have a wonderful week and take care. Thank you so much. And thanks to all of you watching the recording. Thanks for spending time, guys. I really appreciate it. Have a good one. See ya. Okay, bye. Okay, bye.